here. Um, so
Seema. Maybe I'll just add that Seema, as you know, we support the cohort of women-led startups through our program Climate Ready for Women. This is the third cohort that we are running, and it's specifically for women-led startups in energy. So all of these are clean energy businesses that we're supporting. We do have a few other women entrepreneurs joining us from the ecosystem. So we also have opened this up, looking at the interest in the fundraising session, and generally, there's a lot of women interested in how to fundraise, because I think that's where everybody's struggling. So we're very excited about this session. We've been long waiting for this session, I think, all of us, and it would be great if you could, touch upon the basics of fundraising, and also, your experiences with women-led startups and how to go about it in early stages specifically. So great to have you, and I'll hand it over to you.
Got it. Great. No, thank you so much. So we'll try to do the best we can. I do have a hard stop in about 30 minutes, but I'll try to push. I just texted them. Give me 1 second. They just responded. So I might try to go over a little more, but hopefully we'll cover a good amount by then. Does that work for everyone?
Sure, of course. Yeah.
Okay. All right. So let's do, basics first. First of all, we have to understand not all money is equal. It comes in different, some of it might be basic for some of you, but it's always a good start to get everybody on the same level in terms of understanding what's out there. So this is funding 101. You need to understand that there are different buckets from where you can get money. It doesn't always have to be just the VC. In fact, the VC world is not suitable to most companies. And so while I'm a venture investor myself, I'm telling you that we are not the only solution and the only game in town. There's a whole lot of other areas you can go. The way to look at the world of funding solutions is how much returns and how much risk are the investors taking. So the higher the risk, like any one of you would say, higher should be a return. And if you have a way to de-risk your investor, and I talk about that in the next few slides, the lower is the return is what is returned to the investor is cost to you. So understand that a debt is an instrument where your bank loans, where you are obligated to return the money, and also with interest. And if you don't return it, depending on what you have pledged as collateral, that can be taken over. So you need to be very careful about what you're signing up for. While that may seem like a great idea because it's the lowest cost to you, the point is if you are a company which is not generating cash flow, for example, if it is debt with no moratorium and you have to make payments and you don't have the money, then it makes very little sense for you to try and optimize on the cost of money to you versus the risk that you yourself are taking in not being able to pay that bank loan back. So and no banker would give you 100% of your funding needs, because they also want to de-risk. They want to make sure that you are in a position to be able to return that money. Sub-debt is just another what's called mezzanine debt. It is a level of debt that is higher risk in that the person who's giving you the loan, typically NBFCs, they don't have a collateral of your entire business. And they come behind what's called the senior debt or the debt people. When I say behind, it means if your company was to go belly up, in that if your company was to say, I'm liquidating, the first guys who get paid are the debt holders. The sub-debt guys get whatever's left over. And so because they are not getting coverage, they charge a higher cost to you, which is a higher return to that class. Now, this whole pool over here is the equity pool. Equity, the distinction is that they are basically your partner, and they are in it. If you sink, they sink. If you swim, they swim. So if you fly high, they want a piece of that action, and because they are taking the most risk. But risk within the equity pool is also of different categories. So for an angel to come in, when you basically, some of you said you are at ideation stage, some of you might have revenue, depending on where you are. If somebody is just taking your idea, the 1,000 ideas a day that I get. So the world has, millions of ideas. And unless those ideas are converted into some kind of a business model that is actually ready or should be ready to execute and get revenue, it is serious high risk. And so they typically expect the most. And this angel round, by the way, there's a friends and family round where your parents or your whoever has given that money. Then you get to angels. The VCs are looking at some level of, while they are, again, within VCs, there are all kinds of VCs. See, pre-seed, seed, pre-series A, series A. And they typically come in at a stage where you've had a little more than just an idea, unless you are like, Jeff Bezos and now the Nike lady, or somebody who's done so many businesses and proven to the world that they're betting on her or him, and the money won't go down. So they want to see some level of traction in some form, and the forms can be many. I like to say for our fund, the VC fund, which is called All Funds, we want to see revenue, because I think ultimately the best judge of whether a business idea is good or not is a paying customer. But there are some companies where earning revenue is not part of the initial model. We don't invest in such companies, but there are other VCs who do. Private equity is when you're clicking on all cylinders, you're a more stable company. They are so you've de-risked them from a standpoint of saying, okay, we've got the whole cash flow going, we are generating most definitely profits or close to profits, and we are a stable company. At which point competition's also caught up if you were that great in what you're doing, because they're like, okay, she's making money, so I can make money there. And so the return expectations go down. You have de-risked the investors. So for all of these reasons, the cost goes down. So this is the universe of fundraise. Are we good with that? All right. So debt and equity, basically two buckets. Now, here are some schemes that came out. Some of them, this could need some updating, but there were some schemes that came out in response to the COVID crisis that institutions like SIDBI and then banks in India launched. So there were some, SIDBI launched some that were specifically for women, and they were collateral free. So for example, you can see there was the SAFE, which was the SIDBI assistance to facilitate emergency responses. Now this might be over, but up to 50 lakhs, you did not have to have any collateral. Collateral is what you can give to the bank or the source of debt, as what I talked about, which was if you don't perform or if you can't return what you promised to return, they'll come and take control over it. It could be machinery, it could be anything that they find as acceptable collateral. All right, so there are a bunch of schemes that came out. Highly encourage you to look at SIDBI as an area, but also banks. So Bank of Baroda had come out, Indian Overseas Bank, Bank of India, all of them came out with COVID response schemes. There were ACT grants that came out. Oh, the one area I haven't talked about in this schematic is a grant. So depending on where you are, the government has schemes and also some foundations have schemes and grants where they are, especially in sustainability, you will find some grants that you should be actively looking. The beauty of grants is none of this applies, because you basically grants don't come with a cost. So you don't have to return the money. But these are people of foundations or institutions that have the wealth and have chosen that your, a mission of investing in sustainability. So there's a lot of money percolating that you should be looking at from a grant standpoint. All right. So our fund is a gender equity fund, and we draw a distinction. And to us, this is very important. Why I do this on a daily basis is to provide women essentially the higher stepping stool to reach the same opportunities. So to us, this, while it may seem like equity versus equality is not a big deal, to us it is. And it is not giving the same level stool to reach the top shelf. It is giving a higher to accommodate for, in this, it is metaphoric because we are trying to say it's not the height, it's more the fact that we need to have given women the opportunities to have grown with society, and for a variety of reasons, culture, society, just part of being raised the way we were not allowed to grow to our fullest potential. And that's what I'm a passionate believer of. I don't believe that there is no gender bias. I think there is gender bias. So I've taken it upon myself to launch a whole fund that'll provide such opportunities. All right. So what do investors look for transitioning? Well, the first thing is team, team, team. It's true irrespective of what your business is. It doesn't matter which industry, it doesn't matter which country. They are going to, and especially at your stage, especially at the venture stage. So the rest of the conversation is going to be about essentially your stage companies, which is more probably seed, pre-seed, or even pre-series A in some cases. The first thing they look for is your team. Figure out a way to have the most robust team and give the investor confidence that you will have what it takes to deliver. Because like I said, there are 1,000 ideas that I have in a day. And so ideas are worth nothing if they haven't been converted into executable plans and executable businesses. Complete to the best extent you can the team members that'll help you get there. And this is the most difficult part, and I'm an entrepreneur myself because I'm launching a fund too. And this is an area that doesn't come easy to find somebody who thinks like you, who can be with you, because it's kind of like a marriage. You have good days and you have really bad days, and you want to stick with people. All right. So then the other thing is, once we've looked at that, then because we know we have de-risked, irrespective of what the investor says, everybody is trying to find a way to de-risk. All right. So the first things we'd say in terms of, and this was a slide that I'd shown you about the returns being commensurate with risk, as people investing in equity, we first say, how defensible is your business idea? You should communicate that in your pitch very strongly. And that's why I asked her, was it Geeta? I think I asked Geeta, do you have, when you say your plastics are being pulled out of oceans, is it defensible? Do you have proprietary, do you have patents? If you do, absolutely highlight that, because that becomes very important. Once we know, and the whole idea of the defensibility is that allows you to create a moat around you, which competition will take some time to get through. If you can make money, the other guy will come across that idea and say, oh, I can make money too. And you'll have competition before you know it. And so protecting yourself with, especially if you're a high-tech business, patents and any level of intellectual property protections that you can get, you should get it right away. The next thing we look for is scalability, because we see is the way we'll make money is to see the value of your company appreciate. The value of the company will appreciate if you do one of two things. One, you increase the top line, which is revenue. The second is you increase the bottom line, which is the profits. Now, there are different VCs. Not all VCs are equal. Some people just want to increase scale with no regard to OYO being an example, or WeWork being an example. You just scale, grab market share, and people keep pumping money. We are not that kind of a fund. We want to have scalability, but we also want to have some level of at least visibility to profit, if not profits that are happening right away. So there's no one size fits all in that manner, but in general, we want to see revenue growth, because from that revenue growth and scalability, it can't be flattish and generating, 1 to 5% growth year over year. That won't excite a VC. And then we are looking for an ability to exit. So you can't just say, and if the lack of exits is plaguing Indian VC so much, that if you figure out a way that you will help your investors get exits, you will be golden. So all of this is basically then to de-risk it to the extent possible. And the one thing that again is underappreciated by a lot of people is the fact that oftentimes, and this happened far more than I'd like to have seen, the capital is never used for, many times is not even used for what you took the capital for. And this is an amazing red flag. It keeps us up at night as investors, where for me, money is a product. I'm taking somebody else's money to make that investment into your company. If you say, I need X million to invest into growth of technology, and you blow it up in parties and treating your family, that is serious concern for me, because I know then the company is not going to grow. Or if you dramatically change your business line and say, wo to theek hai, but now I'm going to use my money to grow I took it for purpose A, but that feels a little difficult for me. So why don't I just go to purpose B? Because there I'll scale up much faster without informing or getting the consent of investors. That's entirely unacceptable. It seems so simple, and yet a lot of people don't do it. So we would like to know what we're putting our money in. How can you add value to your business? So this was a question I think Priyanka raised. The best time to ask for money, now this may seem counterintuitive, but the best time to ask for money is when you really don't need it. This is just human psychology. You'll negotiate harder. You'll negotiate because you don't have that desperate need, right? So you should ask for money when you don't need it, but don't just go today and say, oh, I don't need it, but let's see who will give us money. No, I'm not talking about that. It's not just for the sake of saying I tried and could raise money. No, you have to have an end goal, but don't do it when you are totally out of cash. Do it or you're about to get out of cash, because then you are desperate and the terms can be pretty onerous. So plan the runway, make sure there's enough of a runway. And usually in the past, we would say the company should at least have, pre-COVID was 6 months to 9 months runway in our investment style. But with COVID, we've actually extended that to at least 12 to 16 months, where the company should have cash that we're investing in, with our money included. But we don't know. None of us were ready for or prepared for this, right? So depending on the stage, de-risk the investor. I talked about that in the slide on the different investors. Defensible IP, I've spoken about that. There are different forms of intellectual property that you can get: patents, trademarks, copyrights, and within patents, there's product patent, process patent. Educate yourself on what you can get by way of protection. And which geographies you can get protection. So India, does that patent hold true for worldwide? If you're sitting in India and exporting something to US, is your patent covering you for US as well, etc. So investing in a good lawyer here is definitely worth it. Now, this improved corporate governance, a lot of what I'm saying, by the way, is stuff born out of 25 plus years of experience. Nobody's going to tell you about this because this doesn't seem very math oriented, but I'll get to the math oriented part. But these are more important than the math oriented parts. Okay. They're simple, but they reflect very heavily on your ability to convince and give the investors the confidence. And one way to do that is improve your corporate governance. I cannot tell you how many poorly kept financials we have seen. Take pride in your corporate governance style. It may seem boring. It is boring. I'm not going to lie. It is boring stuff to sit there and say how many compliances did I file for, etc. But if you are in an industry where you are required to have certain compliances in order, do it. You decided to become the entrepreneur. Nobody forced you. So improving your and differentiating yourself with good corporate governance is an easy way to make that happen. The other thing that I've learned over the years is build processes that make the company less person dependent. And it's a thing that doesn't happen easy because a lot of intelligence rests in the person you hire or the person you partner with, and even in yourself. Make a conscious effort to start institutionalizing from day one, and so make it more process dependent as opposed to because if the person ups and leaves, then you're kind of losing a lot. The company is losing a lot of that value in letting that person go. So and that also, in addition to that risk, if you are process dependent, then you can scale up because any person can come, and when you're adding, going from 10 people to 100 people, the 90 other people can just follow a process, right? And at some point, I highly encourage, and women actually do this naturally, focus on profitability. So that's a good word. You don't have to run away from it. And a lot of investors start by saying, no, that's old school. One dip in the market, everybody comes running to the need for profitability. And so if you are profitable, you're just showing that you're very mindful of your own money, and you'll be therefore taking care of investors' money. All right. So how do you actually go ahead and fundraise? So you prepare. When I say get your house in order, get your deck, get your financial model. And I talk about this later at some point, but it is not that difficult to get your house in order in terms of getting a presentation ready, getting processes in place that I just talked about, governance in order, and a financial model. It also gives you, while it may seem academic and say, kya fark padta, we may or may not be sticking to, but the idea of having a business plan and a budget gives you a reference point of saying how far, how much of that have I achieved. The next thing is educate yourself on who you're speaking with. So when you talk, for example, what to pitch to me, we have certain set of criteria. I do not invest in real estate, for example. So if you were a real estate company and approaching me, it'll just show me that you don't care about my time and you're just throwing things at people and seeing if they'll stick. So do your homework, find the right investors, find what kind of deals they've invested in before. And that also then educates you on using your time wisely. The deal process itself, understand what that deal process is a little, and I might go into that a bit. But it doesn't hurt to have, and actually helps to get good legal counsel and advisors. If you don't know, if you've not done this process before, having somebody hold your hand with just reaching out to the right investors, reaching out to the filing of compliances, post-investment, all of that is important. So go into the network and say, ask people who can help. And there are a lot of people who just take money on success fee basis, especially for investments in your size. So you should be willing to pay up that money. All right. Specifically for women, any advice? The most important thing for all of you is understand your equity position. I cannot again tell you how many women have zero clue on what the cap table looks like, even though it was their idea. And they say, oh, it's my husband. And I'm not trying to break a marriage, but it doesn't hurt to say, okay, if I'm the person doing the work, I need to have the equity in my name. Because increasingly, investors like us, we want to back you, not the husband, especially if the husband's not in the business. Again, I'm not trying to come in a marriage, but or it could just be your business friend. And I've seen so many times where the investors, it could be a business partner, have basically taken 76% of equity, and the person whose idea it was is at 24, or a very small amount. The worry with that is, and you should use this as an argument if you're negotiating with a business partner, is that we are investing in you. And that was the whole point. We are investing in you because you is the idea is yours, and the execution ability rests with you. If the business partner does not bring that, or ability, does not add to that ability, then it risks our money, because if you were to walk, then the business comes to a grinding halt. So it's an important argument that you should make, but understand the cap table. I want to tell you, a lot of people, a lot of them say, well, we understand our product, we cannot understand our financials. Let me tell you, there's no rocket science in it. Having done masters and having spent this amount of time, there's nothing that you cannot learn. So it's very simple. You earn money and you spend money to earn that money, and whatever is left is profits. So take charge of your financials, review your financial data yourself, and don't let this daunt you that it's complicated and you won't understand numbers. That is a very 1900s thinking. So we are in the 2022. Educate yourself, be persistent. I personally have been very persistent thus far. And I'm not saying that we've closed our fund, but we are getting closer. And the one thing you can ask a fund is, what else do you bring to the table besides money? And it's a very reasonable, legitimate question. For example, a lot of people are appreciating the fact that we are bringing the ability to focus on, we are bringing an ability to focus on global growth. And of course, we are bringing an ability to help drive gender equity and find ways to open doors and open access to some customers that are also respectful of this. And we bring an ability to bring on additional investors as the need be, because we've been in the market for a very long time, both within India and the US. So it's something that you should specifically be asking your investors. All right, I'll pause there. I've spoken a long time. So any questions thus far before we get into valuation?
Sina, we have 2 questions in the chat box. The first one is for when you spoke about grants. Are grants taxable?
Depends on who the source of the grant is. But yes, usually it is income coming into the company. If there's income or revenue in the company, it becomes taxable. Unless these are given by government authorities and they are specifically designated as non-taxable income.
And the second question is from Arshi. She's asking if you could, okay, what does partnership with investors mean?
Partnership with investors, I mean, the essence there is that think of them as not an outsider, but as your own team, and treat them as you would your own team. So, a lot of people, it's all in the attitude of saying, it's not us versus them, it's all of us together. And that's the whole point of saying, much like you would, and hopefully you would, respect your team and treat them with the transparency that you would, so that they know exactly what's happening in the company. Extend that. Don't surprise your partner. You wouldn't like any negative surprises yourself. And if you have an equal partnership or a partnership, it's not partnership in the legal sense. Well, it is technically, because they are equity shareholders, so they do come with rights and I might touch upon some of those rights that you will be giving to them in terms of information rights, etc. But once you get an investor and you truly have that chemistry, and that's important, especially at this stage, to find investors who will be supportive of you, because every business has glitches. And the best thing you can do is keep a investor informed, and that's partnership. So you don't want them to figure out information from the market that the company is shutting down, or the company lost a big client, or the company lost a big COO, or your partner is going away. Give them that information. You be the first person to give them that information. And that's true partnership.
Right, right. And Anuradha has a follow-up question to this. That is going for VCs risky due to this, if they interfere too much?
Not all VCs. First of all, VCs don't want to interfere. I have a business of my own to run. I have negative bandwidth, zero. It's not even zero. I have negative bandwidth to get involved in your business. The reason we are giving you the money is because we think you can run the business better than we can. Most VCs think like that. Angels, I'm noticing in India, a lot of them, because some of them might be retired, and they have probably a lot more time on their hands. They want to sit and advise you on things. VCs are generally saying, we please don't expect us to step in, because we don't want to step in. Having said that, like any normal person putting their money in, and in this case, because it's a fiduciary responsibility, because it's somebody else's money that they're putting into you, they have to they are required by their own commitments to be the eyes and ears for that money, right? Think about it as you giving your money to somebody and saying, take care of it, then that person better be doing their responsibility and delivering on. So for that reason, they want to have certain rights. Like they don't want to be, you can't just write a check of 1 crore, or depending on the size of your business, or 20 crores or 50 crores without getting an approval. And that's just good corporate governance, because no one person, especially when you have somebody else's money writing, should have that ability. So those are rights that those are affirmative rights that get negotiated in the agreements. But for the most part, VCs are usually very supportive, has been my experience. Now they get a bad name because when things start going south and things start going bad, then differences creep up, because the investors like, wait, I want my money out. We were depending on you. And that's when things start kind of falling apart. And that's when a lot of bad press is given that the VCs were. But having said that, you should never let go of the idea that the only reason VC is putting money is because they have to make money. It is their job to make money. That's just simple. And it's like you are selling your solar lantern because you want to make money. Yes, you're also doing good by sharing the world with sharing a cool appliance, but you wouldn't keep doing that if you didn't make money. In your case, it's a solar lantern. In my case, it's money. It's no different. I have to make money on my money to be able to stay in business.
Right.
Yeah.
Yes.
All right.
And
should we move
next
on?
Question.
Okay,
Just
go ahead.
2 more questions. That what is the right way to approach a VC network? Because cold calls don't help much.
The best way, you're right to some extent. If you have a super crazy, compelling idea, don't be shy about approaching a VC, because we're all looking for deals. We are very, very interested. Most of the time, it helps. But again, depending on the stage, like if you have some referenceable investors, they could be referenceable angel investors, we'll sit up and notice. Again, the lens you have to look through it is, how can you de-risk an investor? If you tell me Falguni Nair is invested in you, I'll sit up and notice that, right? Because that tells me somebody who has intelligence on making money notice that. So and in that case, cold call is totally fine. Usually introductions help, but don't wait for the perfect day of somebody making an introduction. Because if your business has merit, people will pick up the phone or respond to your email. In fact, we have reached out to people who were not even looking to find money because we read about them in some place and we found that idea very compelling. And you're like, oh, this one is cool because we have our own views on trends, on what's important, what'll grow, and we are looking for entrepreneurs in that space. So we are never shy of picking the phone. In fact, I was talking with this guy, the Naukri guy, Sanjeev, and he picked up the phone and called the Zomato guy when Zomato was nothing. And he said, it was interesting what he was doing. I really liked. And he had just used his service and he was like, this is pretty cool. And the Zomato guy never responded forever. Then he said that call seemed different and they finally responded and he got the investment. So there's nothing wrong about cold calls in my book.
Right. And
Uh,
Archie is asking if you could explain governance a bit more.
Sure. So governance is, it's basically all the controls, checks and balances that you have to take to run your business effectively. It's on the financial side. Do you have controls and checks and balances? Do you have the reporting requirements for any investor to draw comfort that money is not getting siphoned off? And you can prove that if you take 100 rupees for causes ABC or reasons ABC, you actually deployed that. So that could then get reflected. Do you get your accounts audited on time? Do you file your annual reports on time? Are you wasting? All of this might seem very small, but if you do things on time, it just shows that you can follow process and you have the compliances in place. Also, if you are in a regulated industry, do you have the licenses that you need? Do you have the permissions? Like if you're doing, none of you are in that, but if you were, say, a fertilizer company and you need certain government approvals, are you violating that by selling product that is unlicensed? Because that, again, if as an investor, if the government pulls you on that, then we end up as equity shareholders spending a part of our investment into just paying for the penalties. Are you GST compliant? Are your taxes paid? Because we don't want accrued taxes paid on our behalf, from our money rather, on your behalf. So just because you did not pay on time and there's a huge bill mostly made up of interest accrued, that is a serious problem for us, because our money is going into making your product, your service grow. It's not for bringing you into compliance.
Right.
So those are the usual metrics, filings, taxes, regulatory licenses, etc. All right.
Great. Yes, thanks. Thank you so much.
Okay.
There's one more question, but I'll let you proceed and we'll take these questions, the upcoming ones at the end.
Yeah, I am over time, but I did extend my thing by a little bit. So, and in fact, they're calling right now. Can you give me half a second? I'll just tell them.
Sure.
Or let me just text them. Okay. All right. So valuation, how do you value your company? Now, look, there are usually three approaches to valuing. Some at your stage, mostly it's the market approach, because depending on where you are, asset approaches and income approaches are more a function of established companies, because asset approach is what is the value of your asset less liabilities, that's the net worth of the business. You don't really have any assets per se at this stage of the game, so that may not be as applicable. Income approach is more, you project a stream of revenue and a stream of associated free cash flow from that revenue, and then you discount it using what's called a cost of capital down to the present, and that becomes your net present value, and that then becomes a basis. A lot of the people don't actually follow. They would say they follow, but at your stage, a lot of investors I've noticed don't follow. I mean, we we've been told that we are very thorough in our valuation analysis. I guess we are old school. So we do look at a financial model, and we build one if we are asked to look at it closely, or we encourage building one. But what's prevalent in the market is really a trading multiple rule of thumb of saying what else in your market, whether it be through, in your case, it'll be mostly not so much IPO multiples, though that can be applied, but it's mostly what is happening with other companies in your space, in your industries, and what is the level of funding they're getting. And was it, if you're all pre-revenue and the competition is pre-revenue, and then you also have to see what else did that competition bring to the table. That's what throws my head off, because sometimes multiples don't even make sense, because if you have no money, so you have no margin, how are you going to apply? Because any number divided by 0 is non-defined. So you can't really apply a multiple. And then on margins, then you take a proxy measure for it. So it could be how many installs, social media metrics now on how many installs you have, or how many downloads do you have for your app if you're an app company, how many customers have signed up for, if you are a solar company selling lanterns, how many people have shown an interest in acquiring your lantern, or if you are in Geeta's case, if you're pulling plastic out, do you have contracts in place where, again, it's adding some value to your company. So those become proxies if you don't have any revenue, or if you don't have any profit margins, even at the gross margin level. And those are usually the ways that you get valued. The things that you want to be, now here's the other thing, don't fixate on the price that you're getting. A lot of people are using safe notes, but safe notes are not legal or allowed in India, so they use a convertible. So we've always invested in convertible instruments. But my biggest advice would be, don't get fixated on so much. Yes, it's important to get high valuation, but also look at terms of what they come with. Because I could construct a term sheet which has a low valuation, but returns to me a higher return based on the additional terms that come into that. And that's where you need to be entering this with your eyes open. So the things that you should be careful about is definitely the enterprise value, understand the pre-money, post-money valuation difference. The type of funding that you're getting, is that convertible debt, what instrument are you using? So you could have, as I began this talk with, you could have debt or equity, but you want to then see within that debt whether it is convertible, compulsorily convertible, is the equity instrument you're using preferred? Because preferred, remember that thing I started with by saying, if your company goes belly up, then there's a pecking order. And the pecking order basically would be who gets to stand first in line to get the money out. Common equity is right at the end. So if you're giving somebody preferred, which is a position we take always, then in that scenario, we get ahead of you, the founder. The stakes to be sold in the business, a lot of times, especially at this stage, these are mostly non-prize rounds, or they come with what's called a cap. So for example, we just invested in something where we said we are at a 20% discount to the next prize round, but we will convert with a cap of 5 million. So if the company raises money at 10 million in the next round, I would convert at 5 million, even though the new investors are coming in at 10 million. But if they raise the next round at 3 million, then I would be at a 20% discount to that 3 million. So that kind of is important for us, but it also gives you a sense of the percentage shareholding that you as a founder will have. understand whether by the time you get to definitive agreements, those contracts are binding, they are legally binding, but the term sheets are usually non-binding, though I'm noticing more and more investors are saying, and especially at the startup stage, saying we need this to be binding because to put in the kind of effort and time it takes to do due diligence, etc., at some point it has to be worth an investor's time to spend that kind of time with you. But there's usually a courting period where they're willing to give you a non-binding agreement. But the concern from an investor standpoint is, are you just going to take that and shop it around and then leave the investor out? And the investors put in all that, because the one asset we have in addition to somebody else's money is time. And so if I can't use my time well, then that's the one non-renewable asset, sadly, in this world. Understand what kind of class of shares, I've talked about that. Liquidation preference, again, it's something that as a right I negotiate, saying the first X, you are the business, you believe in your idea, I'm going in it because I think you believe in your idea, but you know your idea better than I do, and I ever will. So we want to go in and have a liquidation pref, also called liq pref or liquidation preference. And we typically say when the exit event happens, we need to get a preference in getting our money out, after which we will let you take yours. That's a very standard industry norm. So you can have within liq pref, you can have different kinds of liquidation preferences. You can have non-participating, capped participating, or uncapped participating. Basically the difference, now we really get into the weeds and details, but the high level is that non-participating would be, I'll take my money and I'll be out. In participating is, I'll take my money, but then also participate in whatever remains out of the pool after I've taken out my primary money, and participate in that because that's my upside. And so those are rights and issues, as you can tell, that we negotiate very heavily, because those are the very things that give us some comfort and allow me to sleep at night, because otherwise, there's very little protection that we have. And the other additional rights that we get as investors are voting rights. We get some veto rights or blocking rights. So for example, that I used, if you are investing, we will not let you invest more than X lakh or X crore, depending on what the size of the company is, without our approval. These are affirmative rights. And it's also to be a check and balance on the founders and the core management team. And they get negotiated fairly heavily. The one thing, information rights are, you will keep telling us at periods of regular periodicity what the company is looking like. And then the preemptive rights, like I said, these are veto rights. You will not only will you tell us about future financing, but you'll also, oh shoot, I'm really over time. You'll also give us the right to invest in future, so we are not diluted. So let's end it here, folks. And I do have to hop off, but it's been great meeting all of you, and would love to stay in touch.
Great. So, Seema, thank you so much. I know that we took a lot of your time, but if there are any more follow-on questions, because, there always are, would it be okay if we got those questions from the cohort and passed it over to you?
Absolutely. Would be happy to help.
Okay, wonderful. That's lovely. Thank you so much. I mean, I think it was all from your experience. So it was not, just theoretical, but it was a lot of practical learning. Thanks for making this so interesting. And yeah, thank you for your time. I won't take up a lot of more of your time. Thanks a lot.
Thanks, Julie. Stay in touch. All right. Bye-bye. Bye, everyone.
Bye.
Thank you, Seema. Bye.
Bye.
Thank you.
Thank you. Thanks, everyone. Feel free to email if you have any questions. Bye.
Thank you, everybody.